Muito bom, boa tarde a todos. Bem-vindo a essa fantástica live com Jay Pelosky. Eu sou Roberto Attuch, CEO do OMINVEST. O Jay vai se apresentar agora, a gente vai fazer a live em inglês, mas o Jay é um dos estrategistas mais bem-sucedidos, não só da América Latina, mas também de mercados globais, mercados emergentes. Ele trabalhou 15 anos no Morgan Stanley, onde foi estrategista-chefe. Agora ele tem a seu próprio business de estratégia. O Jay falou hoje cedo na Bloomberg, ele costuma falar direto na Bloomberg, CNBC. Então, antes de eu passar a palavra para ele, ele vai se apresentar, vai falar hoje sobre as eleições americanas, sobre estímulos, vacina, e como que ele vê a alocação de ativos dele, quer dizer, a recomendação em função do outlook dele da eleição. So, yeah, thanks very much, Jay. It's an honor for OMINVEST to have you with us. And I'll let you do a brief introduction now, and talk a bit about your Brazilian background when you started the business, Morgan Stanley's equity business in Latam, and then we'll get going. And I'm sure it's going to be a great discussion.
Great, muito obrigado, Roberto, and bom tarde, everyone. It's great to be talking with the Brazilian audience. I was saying to Roberto that Brazil was one of the first places I was active in way back in 1990. I joined Morgan Stanley, and the first job they asked me to do was to start a Brazil fund. And I worked with Unibanco and BNDES and launched a Brazil fund. And it was a great lesson because it was almost impossible for Morgan Stanley and the IFC, which is an arm of the World Bank that was helping launch these country funds, virtually impossible to raise any money. But if you look back at a dollar-based chart of the Brazilian equity market, you'll see that 1990 was pretty much the absolute low. So it was a great lesson in the time to market versus the time to invest, right?
Yeah.
Market when everybody's hot for something like technology or Ant Financial or something like that, but you want to invest when basically it's hard to raise money. So Brazil has always been a special place to me, and in fact, I took my family there on vacation last spring. We were in Trancoso. So Brazil continues to be a place near and dear, and very excited to speak to your audience today. So thank you.
I appreciate that. So yeah, no, thank you. And without further ado, I'll let Jay talk about his agenda, and it's have been a few hectic days. Yesterday today a little bit more calm. So he has of course a global view and an excellent top-down approach. So he'll talk about what's really important, what's driving markets these days, and not just these three issues, but and also you can ask questions to me in Portuguese, and you submit them in the comment section, and I'll be moderating them.
Great. Well, thank you, Roberto. And yes, we will talk about the coming clarity, which was kind of the title of my latest monthly that we produced last Friday. And I was on Bloomberg TV this morning and raised the question of whether yesterday might be the point of maximum uncertainty. And it was a pretty ugly day, right? I mean, you had stocks down, bonds down, commodities down, gold down, very few places to hide. But there's a historical fact that I want to bring to the audience's attention. It could have been worse, because yesterday was actually the 91st anniversary of the original Black Monday in 1929 that really started the great financial crash and the Depression. And that day, 91 years ago, yesterday, the markets were down over 12% in a single day, which was certainly shocking in those days and would be shocking even today. So yesterday was only down, a quarter of what it was 91 years ago. But still, obviously, a down day. So the things I want to talk about first, are the election, the U.S. election. Second, stimulus, fiscal stimulus, primarily in the United States, but we'll talk about other places too. And then third, the outlook for a vaccine, which I think is also critically important. And that will set us up for a discussion about next year, a little bit of outlook into 2021, which I have said I expect to be a boom year. So an economic global boom in 2021. And I'll kind of lay out the case for that as well. And then, as Roberto mentioned, we'll talk about kind of asset allocation and portfolio strategy. And we'll do all that in the next 25 or so minutes. So to start off, the U.S. election, again, maximum uncertainty. There's only 3 trading days left, or 2 trading days left now before election day. And there's a lot of uncertainty around who's likely to win the presidency as well as the Senate. And part of this is, of course, because of what happened in 2016, when everyone predicted Hillary Clinton was going to win and Donald Trump somehow, on the Electoral College anyway, came out to be the victor. I don't think that's going to happen this year. I have been in print and on television with the view that Biden will win in a landslide for several months. And here's a couple of reasons why I think that is likely to be the case. The first is that there's no third-party candidate like there was in 2016 who drew votes away from Hillary Clinton. Secondly, there are virtually no undecided voters. There are about 5% of the electorate defines itself as undecided versus 15 or 16% at the same time 4 years ago. So this is data as of this week. So no third-party candidate, no undecided candidate, and the COVID virus spreading wildly throughout the United States, which I think is going to be a real drag on Republican turnout. And remember, the Republicans are very dependent on an election day turnout at the polls. The president has spent the last several months saying, don't vote by mail, don't vote early, vote on the day of. And so you have a kind of shift in the electorate where the bulk of the Republican votes are expected to come on election day, versus a very large segment of the Democratic vote has already been counted. And so, as you're probably aware, it's front page news, the early voting turnout is off the charts, 5 or 6 times higher than it was in 2016. It strongly suggests we're going to have a very large turnout. In 2016, the number of voters were about 135 million. This year is probably going to be closer to 165, 170 million voters. High turnout. The early voting clearly very much in favor of the Democrats. And while typically early voting doesn't give you a sense of the ultimate outcome, I think this year it might, because of the fact that the COVID virus is likely to dampen participation on the actual election day, physically going to the polling station and voting. There are 3 other things that I would mention that support this idea of a pretty clear-cut Biden victory. The first is that all the polls have been very steady for Biden for months and months. Second, the betting markets predict it, and other markets such as these have been predicting a Biden win. And third, the baskets of stocks that different brokerage firms have put together, highlighting the stocks that would do well in a Biden presidency, stocks that do well in a Trump presidency, have continued to be, the Democratic basket has continued to outperform. So the next question is whether we have a contested election. And I think we've gone from people thinking that there was going to be a contested election maybe 3 or 4 weeks ago before the first debate. The first debate, I think, really sealed Donald Trump's fate. He was so unappealing that I think he turned off a huge number of voters, particularly women voters, with his debate performance. So we went from thinking contested election and people drawing out these scenarios of weeks and months of potential uncertainty to post the debate, moving to a ever more stronger view of a Biden victory and a possible blue wave, blue being the Democratic color, red being the Republican color. And over the last couple of days, that view was shaken up a little bit, not really by polling, but just people starting to say, well, gee whiz, you know, Trump was behind in 2016 and then he came back. And so some of yesterday's action, I think, was people taking some of that blue wave bet off the table. So that is a nice segue into the Senate. And as I think you probably know, the Democrats have to pick up about 4 seats to control the Senate. And in order to control the Senate or in order to have a big stimulus package, you need to control the Senate. So earlier, I'm just going to look at my notes here, because earlier this afternoon, I went to both Predict It, which is a betting poll, and to Real Clear Politics, which is a pretty widely accepted polling organization, to just give you some of the latest data. And in terms of the presidential election, Predict It, which is kind of like a wisdom of crowds type of mentality, people bet on outcomes, and millions of people bet. You can see it on the data. But Predict It today has Biden winning Wisconsin, Arizona, North Carolina, Pennsylvania, and Maine. It has odds tightening of a Biden win in Florida. And the Cook Political Report, which is considered one of the best and most authoritative political reports, has just moved Texas from a Republican-leaning state to a toss-up. And I don't think Texas has voted for a Democratic president maybe since Lyndon Johnson, who came from Texas back in the 60s and early 70s. So that's dramatic. And then in the Senate, Predict It has a couple of polls as to whether or not the Senate and the House will be Democratic or Republican. And as of today, 63 cents was bet on Democrats having both the House and the Senate, up 4 cents since yesterday, versus Republicans having the Senate at 29 cents. So less than half of where people think the Democratic odds are. So, and then another question that Predict It polls on or votes on is who controls the Senate. And as of today, 62 cents on the Democrats, up 3 cents, and 42 cents on the Republicans, down 4 cents. So you can see that the trends are A, pretty favorable for the Democrats, and B, moving in that direction in almost real time. So in Real Clear Politics, which is a polling organization, has Democrats ahead in the Senate in North Carolina, Iowa, Arizona, and Georgia, with South Carolina and Maine being toss-ups. So I think I give you those data points to say that I think it is increasingly likely that we will have a blue wave election, that Biden will win the popular vote very handily, and the Electoral College vote by a significant margin. And this will mean that we will not have a contested election, that we are likely to know the outcome by the evening of November 3rd or November 4th, with Florida being a key state to watch. And Florida, there's been a lot written in the last couple of days. Florida has really upgraded its political capacity, its vote counting capacity. And the folks there feel very confident that they will have a result on the night of the 3rd. And if Florida goes for Joe Biden, it's very, very hard to see a path for President Trump to win, even in the Electoral College. So my base assumption is a Democratic sweep that allows for now shifting to the second issue of uncertainty. So elections, uncertainty around election will be over in less than a week. That certainty on the election front will guide us as far as what we can expect in stimulus. So it's quite clear a blue wave will mean a bigger stimulus package sooner. And you can think about the already approved House bill of $2.2 trillion as a base case for a democratically controlled presidency, House, and Senate stimulus. If you get a Trump win with a Republican Senate, and I think the only way that Trump can win is if the Republicans do hold the Senate, the two voting together, you'll get a smaller stimulus, but a reasonable size stimulus. Think about the White House offer a couple weeks ago, about $1.5 trillion. If you get a Biden presidency in a Republican Senate, then we're going to have a small stimulus. Think about the Senate Majority Leader Mitch McConnell, his offer of $500 billion. Mm-hmm. Basically, to put it in kind of some sense of odds, or sizing actually, not odds, a Republican Senate and a Democratic president is about 25% of what a stimulus package would be in a blue sweep environment. So quite significantly different. But again, the point is that we will have clarity, or at least the markets will be able to start to assume or assign some probability of what size the stimulus will be once we get through elections. So 2 points are likely to be much clearer within a week, less than a week from today. Election outcome, size of stimulus. That leaves the third big issue, which is vaccine. And I think here, too, the news is quite good in that in the next couple of weeks, we are likely to find out from Pfizer and Moderna, which are two of the many, many candidates out there for a vaccine, whether or not their vaccines have the proper efficacy to move forward. And there are others as well. The Chinese have at least 4 phase 3 trials currently underway. And they're likely to also finish by the end of this year. And it's important to note that the drug companies have been producing these vaccines before they know whether or not they work. So in other words, you will have somewhere between 50 and 100 million doses, for example, of the Pfizer vaccine produced before the end of the year, and roughly 1 billion doses produced, just Pfizer alone, by the end of 2021. So I think it's important to understand that we're likely to find out about vaccines in the next couple weeks or the next month at the latest. We're likely to have production of them sufficient so that certain people can already start getting doses by the end of the year. And importantly, the distribution of the vaccines is also going to benefit from the huge advances in logistics and shipping that have developed over the last 4 or 5 years. So while there's a lot of skepticism around COVID and responses to COVID, given particularly the very poor performance of the United States in dealing with COVID, I think it's important to remember that the private sector is going to be leading both in the vaccine and in the distribution. And I think we could be positively surprised by how well that process goes. So if we get if we get clarity on the election, and it includes a blue wave with very sizable stimulus, which includes positive news on a vaccine in the next couple of months, coupled with record global liquidity and supported by a already recovering Chinese economy with growing consumption. Those are the things that I think bring into play this idea of a global economic boom. So let me just spend a minute or two talking about the different regions. We spent a lot of time on the US, and I want to talk a little bit about Asia, and then a little bit about Europe, and then I will plan to wrap up on the asset allocation. So Asia, our whole focus has been, since COVID began, on the speed of COVID. One of the things that we highlighted very early back in the spring was the speed of COVID, the speed of the spread, the speed of the policy response, the speed of the market response to the policy actions, and now the speed of science. And I think a lot of people struggle to deal with that speed because this was an artificial shutdown of the economies, which meant that as soon as we shut down, things had to get better. And markets are forward-looking discounting mechanisms, and the market was looking forward. And so the worst unemployment data was in April. The recession actually arguably ended 3 months ago, right? When the start of Q3 and the recovery, which we just saw the numbers in the United States today, 30+% GDP growth. So the speed of COVID has been something that we've been very, very focused on. Now, as we anticipate the speed of science bringing the vaccine and the distribution. The other thing we talked about with COVID a lot in the last couple of months was what we called our COVID investing formula, which was pretty simple. It basically was, if you control the virus, you can reopen your economy. If you can reopen your economy, you can have a broader financial market rotation and recovery, which can lead to outperformance. And if you look at the best performing major market in the world year to date is China. And China has done the best job by far out of any major population in dealing with COVID. Now, we can argue all we want about the very onset of COVID, but subsequent to the onset, China has handled things better than anyone else. And so it's not a surprise that you have the stock market best performing in the world, that you have one of the strongest currencies in the world, the renminbi, up 5% year to date against the dollar, that you have one of the highest bond yields in the world with a 10-year treasury of over 3%. And China is about to announce and launch its next 5-year plan. And it's going to be very focused, we believe, on what we call the dual, or what China calls, not we call it, the dual circulation strategy, or DCS. And that basically means that in addition to continuing to export, China wants to stimulate domestic demand. That's the dual circulation. External circulation through trade, internal circulation through stimulating demand. That helps explain why they're happy with a stronger currency, because that stimulates domestic demand. And they need to have money coming in, foreign capital coming in, to offset the fact that on a trade basis, they have virtually no surplus. China's current account surplus 5-8 years ago was 10% of GDP.
Yeah.
Here it's going to be less than 1. So if you want to think about opportunity in the next couple of years, I think it's really important to consider China and to consider broader Asia as it integrates. Because one of the main theses that I have and have been developing for years, and my current firm, TPW, uses it as its name, tripolar world. We're basically of the view that the world is integrating regionally, regional integration in Asia, in Europe, and in the Americas. Asia is clearly being led by China. Dual circulation will wrap more of Asia around China because it will people will be feeding that demand. Europe is being led by Germany. In the Americas, you would think the United States would be leading, but obviously in the last 4 years, that hasn't been the case. Joe Biden, if he is become president, has got a long history with Latin America and arguably could be well placed to help drive Western Hemisphere integration. But China, to us, is a market we're quite keen on, both tactically and strategically. And we can talk more about technology and Splinternet and all those things if it's of interest. But let's move on and talk about Europe. Europe clearly has been, from a portfolio perspective, as I described it today, a bit of a problem child. It hasn't really worked, but we're quite keen strategically on Europe over the next 3 to 5 years. Europe has a joint recovery fund that's underway. It has its Green Deal, which is very powerful, and they're gonna marry the two of them. And it has a long-term budget, 7-year budget structure. So those three things combined suggest that Europe has its medium-term strategy pretty well in place. And we think that Europe is going to be the kind of regulatory body of the three main regions. Asia is going to be the consumption and growth region. Europe is going to be the regulatory region in technology and in climate. Again, it leaves the question of what the Americas are going to be doing. It's unclear to me at this point. But we're of the view that Europe could potentially be the winner of the decade of the 2020s. And it needs to use the virus, use the uncertainty of the present day when we're all concerned about lockdowns and partial lockdowns and 1-month lockdowns and saving Christmas. The bigger point by far is, how does Europe drive integration? And the point I would make is, most recently, is the joint issuance of European government debt. Because Europe, as I'm sure many of you know, does not have a European safe asset, right? They use the Bunds, the German government debt, as their quote unquote safe asset, the equivalent of a US Treasury bond. The problem is that the Germans, as we know, do not spend much in terms of deficit spending. So there are very few of the Bunds out there to buy, which means their price is always quite high and the yield's quite low. So Europe just launched in the last week a jointly issued, so European issue, EU bond that was oversubscribed by something like 15 times. Not quite as much as Ant Financial was oversubscribed, but pretty good for a bond. So to me, that's really pretty constructive. And so we're pretty constructive on Europe on a medium term. So let me just have another sip of water, and then I'm going to talk. I'll finish up on kind of where we are positioned in terms of asset allocation. So we believe that as we get clarity on those big three issues of elections, stimulus, and vaccine, that clarity is going to lead to a catalyzing of what we call the rotation trade, which we think is both sectoral and geographic. So sectorally, away from technology to financials and industrials, away from growth to value, away from large cap to small cap, and then geographically, away from the United States to the more cyclically exposed developed markets like Japan and Europe, as well as parts of the emerging, what's kind of known as the emerging markets. So that's our first big view, that we get the clarity It catalyzes the rotation trade, which has been going on in fits and starts for the last several months. Even month to date after yesterday, small cap is significantly outperforming large cap in the US, and value is outperforming growth. So pay attention underneath the day-to-day action about what is actually going on, where the money is starting to move, because growth and value, as I'm sure you know, is wildly extended. Growth is so massively outperformed. Just like the US equity market has so massively outperformed the rest of the world since the low in 2009, all these relationships are very, very stretched. And so if we shift and move in a different regime, into a different market regime, the returns are going to be significant if you're in the right places. And so for us, the clarity that we're looking for here, we think could tip a lot of these trades into finally taking place. And then the amount of money that can shift from one to the other would be huge and carry us potentially for several years. So that's the equity side. The fixed income side is that this rotation will capsize or sink the bull market in long duration sovereign debt that has been underway for almost 30 years, right? US interest rates peaked in 1980, 81, and they've been steadily going down. I think we're probably just at the turn when rates start to go back up. So if we get the boom that we're looking for in 2021, if we get the clarity, if we get the blue wave, if we get stimulus, if we get a vaccine, there's no way that the US 10-year Treasury bond is going to trade at 1% or less. It's going to trade at 1.5 to 2. There's no way the German Bund is going to trade at minus 65 basis points. It's going to trade closer to 0. I said that today on Bloomberg, and the anchor just practically laughed in my face on live TV, because it is no way, people can't even comprehend the idea of a Bund with a positive yield on it. But I think it's quite possible. And so we're talking about potentially, the way we put it is that the portfolio that has worked the last 10 years and year to date is highly unlikely to work in the next 10 years. So we believe we're really in a regime shift kind of world. We're shifting from monetary policy to fiscal policy. We're shifting from fighting deflation to wishing for inflation. We're dealing with climate change. We're dealing with inequality. There are a huge, just a range of things that are in transition. And in these environments, technical analysis is worth thinking about. And if you follow technical analysis, and I'm not a technician, but I use it as part of my process, we're very close to having the 30-year government bond in the US break down and go into a bear market. It's quite clear that big cap technology in the US is rolling over. It's quite clear that the markets that we're talking about, value, small caps, cyclicals, financials, industrials, are in the beginnings of upswings. And let me just take a minute to talk specifically about technology. I'm of the view that what we're talking about represents almost kryptonite. If you think about Superman in your comics as a kid, rising interest rates and a vaccine are kryptonite for big cap technology.
Yeah.
Completely takes away the work from home fad that everybody's talking about. It means that all the returns of this year in terms of business success are simply being pulled forward from 2021 and 2022, which means that next year tech could be very disappointing in terms of its earnings outlook. Interest rates, low rates, have been a mainstay of the big cap tech trade because it allows their cash flows to be much more highly valued. Rates go up, cash flow value goes down, the case for tech becomes less. Regulatory pressures in both Europe and the United States are increasingly likely. In the United States, I don't think it matters which, whether it's Trump or Biden, there will be regulatory pressure put on the big cap tech stocks. So to me, technology at this point, one should be selling technology and buying things like financials and industrials. I do think technology is interesting in the emerging world, and we do like the tech chain in East Asia. So South Korea, Taiwan, China. I think technology stocks in Latin America are very interesting. There's an ETF symbol EMQQ, which I think is really worth taking a look at. So where we are then is we are bullish equity. So on a multi-asset basis, overweight equity, underweight bonds. Within equity, underweight US, overweight non-US developed markets, Europe and Japan. Overweight Asia within emerging markets. Overweight small cap versus large, overweight value versus growth. Fixed income, significantly underweight long duration government debt. We like credit, we like US high yield, we like US preferreds, we like emerging market dollar debt. That's where we'll take some duration risk, dollar debt, yen dollar debt. We're getting increasingly interested in real estate. Within commodities, we are bullish commodities, both industrial metals as well as precious metals. We think real interest rates are going to continue to be quite low, which supports the case for gold and gold miners. We prefer gold to silver. We like the industrial metals. We like both clean energy and increasingly old energy, i.e. oil. If we're right in our global economic boom perspective, there's no way that Brent is going to trade at $37 a barrel next year. So when you're thinking about like right now with all this dislocation, what should I think about buying? Oil and oil-related stuff is really being hammered. And if you have a 6-month view of a better growth outlook with a vaccine, with record liquidity, with stimulus, then that's probably a pretty good place to look. And that's, in fact, where in the last couple of days, in the last week or so, I've been doing some buying. So I think that pretty much covers most of what I wanted to talk about, Roberto. I'm sure there was other things that come up in question, but why don't we stop there and see if we have generated any questions.
Yeah, we have. Thanks, Jay. Fantastic presentation. I have a few questions. There's more questions from the audience too. So let's start, from the beginning of our presentation. So of course, a lot of people are talking about the elections. And we also had the same call that it's all about Florida because and let me know if you agree that the Trump strategy has been based on being able to declare victory on election night and try to delegitimize the votes coming from the mail. And without Florida, there's no way that this can happen because he has no path to victory unless he wins Florida. So even let's say he happens to win Florida, and we do have a blue wave because Biden may win even Texas or have a full sweep in the Midwest. How does that play out? I mean, if it takes 2 or 3 days, for Biden to be declared the winner, even if it's a blue wave, a landslide.
Well, I do think, Roberto, it's a good question. I do think the president has actually hurt himself by all his talk of fraud and rigged elections, because what it's done clearly is it's stimulated an absolutely massive early voting wave. And surprisingly, it could be that the early votes and the early counts on the night of the 3rd are overwhelmingly Democratic, favoring Joe Biden because of that bank of early voting that is going to be there when they start to report the numbers. So it's actually probably going to be more like the Blue Mountain, and then it gets eaten away a little bit as Republican same-day voters, get tabulated, get counted, and then we'll see, kind of where it ebbs and flows over the course of the night. I mean, I do think, from what I've read in the last couple of days, I do think there's a good chance that Florida will be called on the night of the 3rd, whether for Biden or for Trump. And I do think most of the other states, all but 2 of the battleground states, allow for vote processing before November 3rd. The only 2 that don't are Wisconsin and Pennsylvania. This is an important point. So other battleground states, Arizona, North Carolina, Georgia, etc., those votes can be processed, maybe not counted, but processed. So they're ready to be counted as soon as, 8 o'clock in the morning on the 3rd. So there's really only 2 states. And as I mentioned, Predicted has Biden ahead in both of those 2 states that don't allow for accounting early, Wisconsin and Pennsylvania. In fact, the Biden polling in Wisconsin is something like 14 percentage points ahead of Trump in the most recent polls. I mean, in Wisconsin right now is one of the hardest hit states for COVID, where the governor just came out yesterday and urged people to stay at home unless absolutely essential. So, I mean, I really do think that the COVID surge in the United States here is going to dampen significantly the Republican get out the vote effort on election day.
Yeah, I know, fantastic. And one point about early voting, and that's something that people have told me, that there is not a rule and every year is different. But to what extent, these 70 plus million voters that have already voted, how much of that is an anticipation of people that don't want to vote on election day because of COVID, and how much of that is real, increased turnout? So I mean, is there a way at least to read the data and try to segment it?
I don't know the answer to that question. I'm not a polling expert, but I think, as I said just a minute ago, I do think the president, hurt himself. I mean, he has spent a lot of time on television, on radio, saying the election is going to be rigged and there's going to be fraud. And therefore, I think people wanted to really be sure that their vote would be counted. And the way to be sure your vote will be counted is to vote early. And I do think it suggests a massive wave of voting. I mean, I think President Trump is a polarizing figure. You either love him or you hate him. And I think that's why there's so few undecideds, right? I mentioned that earlier. 5% undecided versus 15%, 3 times as many 4 years ago at the same time on October, I think it was October 28th, that data was taken. So I don't really know how much of it was pulled forward, but I do think, as I said, 135 million people voted in 2016. Most of the estimates that I've seen for 2020 suggest 160 to 175 million voters. So you're talking 30 to 40 million more people voting. And that's not demographics. Those are people who want to get out and vote.
Mm-hmm. Yeah, no, fantastic. And I mean, I was actually, chatting with someone the other day. I mean, could it be the case, because now, I mean, one of the reasons why, if you look at 538, for instance, Nate Schiller, the implied probability of Biden winning, looking at where the polls are in the popular vote, it's like 90%. Mm-hmm. Why do the odds tell us 65%, give or take? It's because I think people are obsessed with 2016, and those are the 2 things which you said are different. So yeah. The question is, and it's kind of a funny one, could the pollsters be erring on the opposite side? So the polls today, instead of being skewed towards Clinton as they were in 2016 for a number of reasons, could they be skewed towards Trump because they were trying to correct the opposite mistake? I mean, we're not posters, and this could be interesting if it happens.
Yeah, no, I mean, I doubt that, but I do definitely think that investors remember 2016 very, very well. And I think there's light positioning because of it. I mean, I was actually a little bit surprised at how aggressive the selling was yesterday.
Yeah.
I thought the day before, when it became clear that fiscal stimulus was dead until after the election, was a kind of pretty good absorbing of that news. Yesterday's sell-off was, it was notably, though, only really, well, in the U.S. and Europe, right? Asia really didn't participate because it is a U.S. specific. Europe has its own lockdown issues. U.S. has its own issues. Asia has been out there like a champ in terms of not really falling prey to this, which suggests to me that the ability of the U.S. to be, the big dog and wag the tail of all the other markets around the world is already ebbing. And so it's a natural extension of that to think that other markets could assume leadership in the next phase, which is something that we've talked about. But for me, the biggest single things, the three things are no third-party candidate, very few undecideds, and COVID is going to limit turnout on election day. None of those are positive for President Trump. They do suggest polling is likely to be more accurate, and it does suggest that early voting surge by mostly Democrats, that much is true. I can tell you that I think there are 33 states or so that show early voter party registration. So you can get a sense of how many of those early votes are Democrat versus Republican, and it's running 2 to 3 to 1 Democrat to Republican.
Yeah, we have. Let's move on. We finish with elections. So there was a comment on the chat saying, actually, out of the 70 million early voters, 20 million of them were first-time voters and mostly Democrats. So I guess it's part of the answer. And in line with what you said, it's true that other markets are taking leadership, and the proof of that is Ant Financial, which is listed in Shanghai and Hong Kong, and not listed in the U.S. Maybe as part of that tension. But given that it's very rare that Europe is the center of action and drives markets, and I guess the issue yesterday was the lockdowns in France, Germany, and people were praising Europe before. So my question now is, do you think the politics of lockdown can be different this time? Because if you go back to the spring, the populations in France, Germany, Italy, even Macron, which had the popularity way down, he saw it going up because people saw that, okay, this is necessary. There was leadership; they have done the right thing. And even in Italy, where people did not protest, there were protests in, not, of course, a lot of people, but in major cities. So do you think the opinion polls, and public opinion could change in Europe as a result of lockdown fatigue?
Well, I think there is that risk, clearly, right? I think everybody's fatigued about COVID, right? It's been going on 6 or 7 months. I mean, the only people, interestingly enough, not fatigued are the Chinese. And I read a very interesting article to the point of work from home and how everything's going to be changed. The banks in Shanghai, in this article, their trading desks and trading floors are back fully staffed, no masks in sight, buffet lunches for everybody. So basically back to pre-COVID age, which I think is kind of fascinating. Europe, the lockdowns here, I think both Macron and Merkel have been very clear to be specific in a timing. It's a 1-month lockdown. They anticipate they're trying to save Christmas. That was the other thing to maybe buffer some of that concern, right? We're trying to do this for Christmas so you can spend time with your families. They're not as strict. Schools are open, factories are open in both countries. And if you look at the mobility data, this is the issue I got into this morning with Bloomberg. Markets in Europe have sold off 10 of the last 12 days. They're back to spring, back to April, May levels. But mobility indicators in the spring were down 80%. These are real-time Google mobility indicators, auto, foot traffic, etc. In Europe now, they're down 10%. So I think the markets have gone back into the mindset of a total lockdown, which I don't think is going to happen. And one of the points I made was the European financials, which is a widely hated trade. I like them and own them. And I mentioned on Bloomberg a month ago, it was September 30th, I called them a screaming buy, which got me a clip because they thought that was so shocking that they pulled the clip of that segment. And guess what? In the 3 weeks after that ETF, EUFN, went up 8%. And in the last week, it's given the entire 8% back. And yesterday closed within 2 or 3 cents of where it was a month ago. But what's happened in the intervening period? You had earnings, and the earnings of the big banks, even Deutsche Bank, which has been, the poster child for horrible European banks, reported way better than expected earnings. The forecast was a loss. It reported a profit. So the banks are doing better. They're capitalized much, much better. Their bad loan provisions, like the US, everybody threw a chunk of money into the bad loan provisionings in Q2. Those are going to be reversed because we're not going to have anywhere near the default rate that we had after 2009 or 2010. So the banks are doing better, yet the stocks are back to where they were before you had that evidence, actual evidence of things being better. So to me, Europe is taking a step back. We're not going all the way back to the spring. I don't think populists really go for it. But for me, the question is, as an investor, what's in the price? And to say that European equities should be priced where they were 5 months ago in the depths of this thing in April and May, that's a mispricing, and that's an opportunity.
Agree. So there's 2 questions from the same client. One is about the dollar. If you think the mighty dollar is going to appreciate or depreciate, given your scenario. And the second one is how do you reconcile your view of higher rates to your bullish call on real estate or REITs?
Yeah, both good questions actually. I should have mentioned the dollar a little bit more. I think I touched on it very briefly. I do expect a weaker dollar. I touched on the renminbi. I think we're actually in the very beginnings of outlining a regional currency blocks, with the renminbi being the principal currency for Asia Pacific, the euro obviously the principal currency for Europe, and the dollar being the principal currency for the Western Hemisphere. I think the US has made a significant mistake in using financial sanctions as heavily as it has in the last couple of years. I think we are basically forcing the Chinese to increase its self-reliance. And I think Ant Financial is a perfect example. You made the point, Roberto, right? The biggest IPO of all time was listed in Shanghai. What more do you need to know?
Yeah.
And we in the United States are telling our companies they shouldn't be involved in China. We are trying to split the internet. We call it here Splintering. And I used technology and climate as 2 of the new drivers to this regional integration thesis, this tripolar world that I argue and I use as my framework to think about the world. So we are forcing China to do a lot of these things, and I think it's a mistake on a number of levels. But what it's doing, and China is demonstrating, it has the capacity by itself to have the world's biggest IPO. There was very little foreign order book in that IPO. It was a huge amount of domestic and near domestic demand. And so China, one of the things we're going to see, it already is the world's 2nd biggest equity market and 2nd biggest bond market, 2nd or 3rd, depending. I think the currency they're happy with appreciation. As I mentioned, it stimulates imports, okay? It binds Asia closer together. It stimulates consumption, which is what they want to grow consumption. Right now, for example, in the US and Europe, consumption makes up about 75% of GDP. In China, it makes up about 45 to 55% of GDP. They want that to go up dramatically. And so part of that is going to be produced in-house, right? Produced in China. Tesla, for example, with a factory in Shanghai, purely devoted to Chinese domestic demand for electric vehicles, which, by the way, China is going to be leading in. So these are the focus of the future. Those things are very much in play. And so one of the things that's in play, therefore, is the primacy of the dollar, to get back to the question. The primacy of the dollar. It's been the currency for a decade. Is it going to be the currency for the next decade with massive fiscal deficits, massive trade deficits, massively over-owned by virtually everybody because everybody's long the United States? I don't think so. So I would expect dollar weakness to be something that goes along with our view of regime shifts in the next couple of years. And then to get to the point of higher interest rates in real estate, look, higher interest rates are not great if they're due to inflation, but pretty good if they're due to growth expectations rising. And we're talking about growth expectations rising. I do think there's going to be some near-term inflationary pressures because we have an imbalance between supply, which is very limited, right? If you look at inventory ratios, very limited, and demand, which is quite strong, right? I mean, I'll give you another example. Bank of America does a weekly credit card analysis over 7 days. So the last week, credit card billings were up 4% year over year, 4%. There's no distinguishable difference between COVID states with heavy COVID cases or low COVID cases. So spending is spending, and it's happening. Savings rate in the United States is 14% of GDP. There's tremendous consumption power. You can see it in homes, you can see it in autos, the segments of the economy that are doing very, very well. So rates, I'm talking about rates going from 0.8 on the 10-year Treasury to 1.5. That's a double in terms of yield, but it's nothing in terms of, it's not going to, people say the Fed is going to not let the 10-year go above 1%. I think that's completely wrong. Completely wrong. The Fed is going to be happy to have rates backing up because it signifies that growth is coming, which means that inflation is going to hopefully be coming. Remember, the Fed and the ECB have signed on to AIT, asymmetric inflation targeting. That means they have a 2% target, but they're happy to have it go to 2.5 or 3%. So to me, I think the question is not does the Fed cap the 10-year U.S. Treasury at 1%, but does the 10-year Treasury end 2021 at 2% yield? Does the 30-year end the 2021 at a 3% yield? Right now it's 1.57. I think you could easily see yields double in the United States. And I think you could still see real estate do well because it would mean, particularly commercial real estate, that there are people starting to rent. I'm in the middle of Manhattan, New York City. I can tell you that the storefront retail space here in my neighborhood, which is one of the best ones in the city, is probably 30 to 40% vacant on the storefront. So there's a lot of potential for those rents, those buildings to be filled, those storefronts to be filled, and people to be very happy, and real estate investors make a lot of money. Right now, the opportunity is where's the yield? Where is the yield? So if you think the economy is going to stabilize and get better, and you can find real estate plays that have double-digit yields, which do exist in the U.S. market right now, I own a couple. I don't think the yields are going to be cut in half. I do think you're going to make a really nice total return on price appreciation coupled with that double-digit yield.
Yeah, no, you put it in a very interesting way, because if you ask a REIT investor, if he would trade, a 90% vacancy, if you'd rather have, the vacancy going from 30% to 0 or to 5%, he would trade that, for higher interest rates, and of course, he would take the deal. It's much better to have higher occupancy with lower rates.
Mhm.
And about your point on the dollar, it's interesting. We wrote a piece way back, with some of our contributors about global currency and everything. And you mentioned two interesting points. One is that, okay, if China wants the renminbi to be widely used, it can't be putting surpluses. It needs to at least if not having deficits, they need to start a shift in that balance. And in your opinion, how much, if we move away from oil and going towards carbon neutrality, how much does that hurt the US dollar? Because part of the US supremacy is based on the fact that oil can only be priced and traded in dollars. So as we move to clean energy, how much does that affect the US dollar? And I don't think that's an issue that most people talk about. They talk about the rates and the Fed, but if we begin to be less dependent on oil.
That's a good point. I mean, I haven't thought really about that either. I do think that you're already seeing Russia and other countries trade oil based in rubles and other currencies. I know Iran also would like to trade oil for currencies other than the dollar. And I do think that the bigger point, Roberto, I think, is that China, in the next 10 years, China is going to need and will internationalize its currency, which almost by definition will mean a increasing competitor to the US dollar. And I'm not talking about, we're not talking about an absolute collapse of the dollar. Yeah. And it is worth, like if you are dollar bearish, as one of my old Morgan Stanley colleagues likes to point out, you have to be bullish about something else. And it's kind of hard to be bullish. You can't really be super bullish the euro, I don't think. I'm bullish Europe, but I don't see the euro, going to 145 or 150. Do I see it going to 125 in the next year? That's quite possible, yes. Do I see DXY, which is the dollar, or frequently quoted dollar instrument, at 93.40 today? Do I see it going, going to 90 to 85? Quite possible. So it's more like a that type of move rather than a collapse. But I do think the bigger story in currencies is going to be the coming internationalization of the renminbi.
And also talking about China, there's a question here on a Biden government administration. I mean, how would they treat China? I mean, would that be less noise and more actual confrontation? One thing we have discussed when we had our call a week ago was that Biden would be more effective in dealing with China, especially because he would rebuild the bridges with the traditional American allies, especially Europe, where the relations are very much strained. So is that effectively the way to deal with China? By making friends with Europe and to some extent Japan again, and not needing to all that talk and and volatility.
Well, I think it will be a calmer environment. I mean, Joe Biden is simply a calmer person than President Trump, and I think he values allies and values what allies can help do. I do think it's also really important to note that Europe needs China, right? Germany sells a lot to China. They're a bigger trade partner than we are to Germany, I'm pretty sure. Yeah. So Europe is not, we do not want to force Europe to choose between the United States and China. And we've kind of done that with Huawei and the tech side and kind of got our way with the UK and others kind of being pushing Huawei aside. But I don't think we can do that very often, and I don't think we'll be very successful going forward, simply because China is going to become a bigger importer over the next 10 years, a much, much bigger importer. And people are going to want and need to be a part of that business. We in the United States will want and need to be part of that business. Why we are trying to force US companies out of China makes absolutely no sense to me. And so I think the issue with the US and China is simply tech supremacy, particularly around artificial intelligence and AI. And that is a battle that is going to be fought and is being fought as we speak. And it's all about intellectual capital. It's all about science and laboratories and research and development and spending and data aggregation and all those things that people know way more about than me. But you know, we were one of the early users of the phrase splinternet. We do think there is a splintering of the internet between a China internet and a US internet, with Europe being the regulator in the middle. Europe has 600 or so million people, and therefore it's a market that both US and Chinese tech companies want to participate in, and therefore they get to be the arbiter of the rules. And so that's a very powerful position. But Splinternet and the AI fight is real. Everything else, I think, will be much more reasonably approached with allies who will tell us that they want to be friends with both the United States and China. It's a multi-regional, multipolar world. It's no longer a unipolar world.
Yeah, that was my last question. You know, we've been here for over an hour, and I would like to understand more, you know, how Europe can use this leverage when you talk about being, you know, the chief regulator and the lead regulator in tech or in climate. Is this because, because of their, you know, not just geographical position, but because, you know, on, it is the bigger market, you know, it's 600 million people with, the highest per capita income, if you look at it on average. So it can, if the Chinese and the Americans want to operate here, they better follow these rules. So, and what's said about Europe is that, it's a big economic superpower, but, you know, it has no geopolitical influence because, you know, of historic reasons. You know, 2 of the 3 largest economies have lost the war. So how can they gain their influence, and how can they project that influence? And because we've seen it's been a battle, it's been a bit difficult for them to regulate, you know, U.S. tech companies. So, I mean, how does that play out?
No, I think that's a great question. Look, this is where the tripolar world construct came from, right? It was an outgrowth of the financial crisis, where the policy response was purely monetary, right? No fiscal response. So all unelected central bankers made the policy post 2009, 2010. Globalization, as we knew it, was over, right? Finance was the tip of the spear. 2009 broke that. And then we had Brexit, we've had President Trump, we've had rise of populists like Five Star in Italy, etc. All those things suggest that globalization as we knew it, the Washington Consensus of the 90s and early 2000s, is over. The question is what replaces it, right? Nationalism really doesn't work in today's day and age. You know, you can't be an island unto yourself. America first, I think, is going to be relatively quickly forgotten if President Trump leaves office after 1 term. What works is sizing. And so to me, the euro was a response to NAFTA. If you think about going way back, NAFTA integrated North America. The euro was the political response to that, because Germany and France realized all of a sudden they're 50, 60 million people by themselves. It's meaningless. But if you gross up to a region of 500 to 600 million people with a $17 trillion GDP, with all the things that Europe brings to the table, then you're a player. And so I think Europe is recognizing that. In a way, President Trump and Brexit have reinvigorated the idea of integration within Europe, and five-star, but to a lesser extent. Strengthen that idea. And that's why I make the point about the joint recovery fund with joint debt issuance leading to a Green New Deal, which puts Europe as the leader in climate, in which allows for next steps. If you have common issuance, you need to have common taxation. What is the common taxation going to be? Could it be a digital tax? Absolutely. Could it be a carbon tax? Most definitely. So to me, these are the things that suggest Europe, it's slow moving, it's 2 steps forward, 1 step backward, it's not pretty, but I think strategically, the Joint Recovery Fund, Green Deal, and 7-year budget, common issuance, potential for common taxation, banking union, capital market union. I think we are going to start to see cross-border financial M&A, for example, in Europe in the next couple of years. And we're going to see European champions. And so to me, as I've said and written, I think Europe could be, I think the 2020s could be the decade of Europe. No one is positioned for that. No assets are priced for that, but it's not a bad thing to think about. When you can buy the European banks at 0.4 times book, 0.4 times book.
Yeah.
It's a pretty clean book. It's been checked over, 5 different ways to Sunday. Versus, I mean, what are the Brazilian banks selling for? 2.5 times book?
Well, a little less now, but they're selling between 1.5 to 2 times, forward. So
0.5, let's say 0.5 times book versus 2 times book.
Yeah.
I mean, it's worth looking at the 0.4 times book, I think. And to me, Europe is not priced for any kind of success. People have bashed Europe for so long, it's like a default mechanism. But if they're able to pull some of these things together and move forward, and I think, as I said, they've been reinvigorated by Brexit and President Trump. They know they have got to get closer together, and they see the Recovery Fund and the Green Deal as almost like twin engines that are fusing together, because a lot of the money for the Recovery Fund has to be spent on climate adjustment. And so Europe will be, in China, look, President Xi made it really clear, China wants to get into the clean energy game, right? Carbon neutral in the next decade. So this is a very rapidly growing business opportunity. And from my point of view, in the United States, we need to get in the game. And that's why from a tripolar region, I struggle to see really what the case is for the Americas. I can make Asia growth consumption story, that's easy. Europe, regulator, climate, tech, easy. The Americas, the US, Brazil, Mexico, Argentina, it's much more difficult to see what is our reason for being. And one of the things that I think could be interesting is to see whether or not President Biden works not at reshoring, but nearshoring, and works with Central and South America to say, look, you guys can be the production platforms for your own countries as well as for the United States. It's all about e-commerce. It's all about delivery next day. Wouldn't it make more sense to have the production chain regionally located as opposed to globally located? I think we're moving in that direction. That's the upside for the Americas, because we have lots of consumption power, but we don't really have the political, thinking to drive that. And so I hope that's going to change.
Yeah, no, we hope to. And of course, Brazil is a bit behind, but I think Mexico will be the country to benefit most from this. This is widely agreed. Mexican analysts in our group, and the issue is a lot of the business community does not trust the current administration. So I mean, I think that's a huge potential that Mexico has. So yeah, I agree with you on Europe. So it's a lot of people see Europe as kind of a no-go market in uninvestable. That has changed with the joint issuance, and Brexit was a blessing in disguise for them. I think. Let me know if you agree. But with UK still on board, they would never get the 750 billion package done. So that's interesting. And yeah, a lot of investors, they see Europe just as okay. There are a lot of savings, huge surpluses, and forget about Europe as an asset class. Just buy, the good, exporters that are in Europe. Be it, machinery, food, luxury, especially. But I think you're totally right on this. There's a lot of low hanging fruit.
Well, and I think that I completely agree about Brexit. By the way, I wrote that. I'm happy. Going back, I thought Brexit was bullish for Europe, and I wrote that at the time, in part because of that tripolar worldview. It gives us a different angle on things. We have a different perspective oftentimes on things such as that. And I think that the case for Europe, as you mentioned, is it could be quite considerable. And the other thing I would mention is that Europe's the makeup of the market, the equity market, has also changed pretty significantly over the last couple of years. And it's a better balanced equity market, like the Euro Stock 600, for example, is a much better balanced equity index across the sectors than it was even 5 years ago, right? If you go back and look, 5 years ago, it was 25% or so banks, and 20% energy, and 15% healthcare. Now, as you pointed out, the luxury goods, because of the China demand, have become much bigger. Healthcare is still big, but you also have a decent tech sector, and you have a much smaller financials and energy sector. It's still cyclical. I think it's still a cyclical bias to it, as in Japan. Right? We haven't even really spoken about Japan, but yet I think that's a very interesting equity market as well, very exposed to China, very exposed to Asian growth. If Asia is really going to grow, Asia pan-wide, right? ASEAN and the Southeastern Europe growth potential, which is massive. If that really takes place, then Japan is a low-cost, low-risk, cyclical play on that. And you saw it just even yesterday or today, Sony increasing its earnings estimates on the gaming side. Gaming, things like that. I mean, there's exposure that you can get there that I think is world-class and is undervalued and under-owned. So, the U.S., I mean, that's my point. If I had to make one to your audience, final point would be, look, don't just focus on Brazil. Don't just focus on the U.S. Look at Asia. Look at Europe. There are lots of opportunities. And my understanding is the Brazilian market is changing, becoming more open to international. The ability to invest offshore is becoming easier, or to invest in offshore vehicles that are co-listed in ETFs and things like that. I think there's, having an open mind and thinking not about what has happened the last decade, but thinking about what might happen in the coming decade is where you're going to be really successful in investing in the years ahead.
That's excellent. Thanks very much. I think it was a fantastic discussion. And we had a huge audience. I'll share the numbers with you later, and I'll thank you very much, for the questions. And again, Jay, thanks very much. We look forward to do more. I appreciate your insights. You covered everything. Relatively short time, but you gave us 1 hour and 20 minutes. So I'll let you go now and watch the close. And again, I hope to have another discussion soon. Maybe as your scenario plays out, and we have a new president a week from now. Maybe we, in the aftermath of that, we can see how things are going. But I'll let you make last remarks, and then I'll let you go. But thanks very much. This was a fantastic discussion.
Great, Roberto. Well, again, thank you, and thank OMINVEST for the opportunity. I think what you're trying to do is spot on and wonderful. Again, always great to converse with my friends in Brazil. Muito obrigado, and thank you very much, and I hope to be with you again soon.
Thank you. Thanks again. Bye-bye. Thanks, everyone.